So while, by no means was the sky falling in LA, prices had just run up for so long. Pair that with the slowing pace of rent growth, and you did see, especially in kind of the eastern part of the county, overall slowing in investment volume and property sitting on the market longer, as you identified.
Hi, this is Chris German from The Apartment Dealer. Welcome back to The Apartment Dealer Show. This is where we bring you the resources, the information, the network of professionals that can help you and aid you in the building of your financial legacy in multifamily investments. Here with me today is Mr. Steve Basham. Steve is with the CoStar Group. If you're unfamiliar with the CoStar Group, it's the nation's leading source for all data points when it comes to commercial real estate. To give you some idea, every major commercial brokerage firm utilizes CoStar's analytics as part of their daily brokerage. Some further insight in terms of how much data is it that they are tracking. Daily, they're tracking 5.1 million data points, and they're tracking 6 million commercial properties on a daily basis, just to give you some idea of the depth of the information that they have at their disposal. And Steve is actually the managing analyst here in Los Angeles County, has been with CoStar Group for nearly 15 years. So brings with him not only that storehouse of data points that CoStar only he has access to by being affiliated with CoStar, but is here with us today to empower you, the landlords, in terms of what has happened during this entire health crisis. 2020 has proven to be a new kind of year. And as we move into the new norm, we need to be able to adjust, to pivot based upon not emotion, but on the facts. What does the data tell us exactly what's happening in the commercial real estate industry today, specifically to multifamily? So Steve, thank you and welcome to the Apartment Dealer Show.
Happy to be here. Thanks for having me.
So for our viewers, those that are questioning, okay, hey, I stay on top of CNN Money. I'm looking at Forbes. How's CoStar differentiated from those other financial resources?
CoStar is concerned exclusively with commercial real estate and multifamily properties. So we are third-party independent information. We are not involved in the leasing or selling or development of any type of property or commercial asset. We're strictly an information company, and our role is to provide third-party independent information to the commercial real estate industry so that our clients can make the best decisions, the most informed decisions based on the best.
So in other words, you don't have a dog in the race. Whether someone chooses to buy, sell, or hold, CoStar doesn't profit any. You're there just to serve the landlords and the brokers in terms of the real analytics.
Exactly. We guard that independence scrupulously. We value our role as the independent third party. So we're not financially affiliated with any brokerage or other entity in the industry, and that allows us to really provide an independent third party view.
Okay, Steve. So what I'd like to do is frame our conversation today. Three major segments, easy to remember: BC, DC, AC. Before Corona, during Corona, after Corona. Because obviously that really is three major parts to the market as we're experiencing it today. So in March, all right, let me back up for a moment. So over the last 10 years, I've conducted live educational seminars, luncheons for apartment landlords. And we've had several thousand investors come through our events. And the analytics we've always used has come from CoStar. So when it's my time to take the stage in between the lawyers and everyone else, the data points we're sharing is all the data that we collect from CoStar in terms of sales trends, price per unit, and so forth. Now, our last event was in March. And in gearing up for that event, we had collected a 10-year run on what had sales volume looked like and where were property values headed, not knowing that my event was actually on March 19th, not knowing the governor the next day would announce the stay-at-home order, and turn, the economy, almost into a tailspin, there for a moment. And so I mentioned that and preface that because, again, this data, it was all prior to any of us knowing that this health concern would enter into the market. And I think that's important because we already saw certain things taking shape in the market. And I would argue that this health concern has just exacerbated what was already kind of showing itself in the market. So the first thing we'll move to is overall sales volume. The overall sales volume, and we chunk it down by various corridors. So we have the 710-91 corridor. So this is going to be your Huntington Park, Maywood, Southgates, kind of like that lower end, of the South LA area there. We have the 605 corridor, Montebello, Whittier, Pico Rivera, Norwalk, through those areas. The Eastern San Gabriel Valley, which really is basically between the 605 and the 57 freeway. East Los Angeles, which is East Los Angeles, El Sereno, those surrounding areas. Pasadena, which we bring together, Altadena, South Pasadena, Sierra Madre. West San Gabriel Valley, so this is going to be the San Gabriel Valley, essentially between the 710 and the 605. And then the Inland Empire, West Inland Empire, essentially everything from Pomona up to about Ontario, and then east of there. So we chunk it down by corridor. And all someone has to do is take one glance at these charts to understand that sales volume has been dropping off significantly since 2017. So the fact that, of course, the market has slowed here currently, but the market in terms of deals the number of deals that were turning year over year had already slowed again since 2017. Now, as we move to, in terms of what have values done here recently, where were they trending? The first corridor we can move to is to the 605 corridor. So again, we see there on the chart on the left, sales volume depicted by the bar graph had slowed down since 2017. Price per unit had continued to edge up slightly, but if you look at the months to sale, or how much time was it taking for properties to sell on the right-hand side there, you see that the days on market had began to tick up. And that really becomes a theme. If you move to, say, the Eastern San Gabriel Valley, same thing, sales volume had dropped off, prices had peaked out as depicted by the line graph on the left, and you look at days on market, it had began to climb beginning in 2019. Same thing if you go to East Los Angeles, sales volume drops off, you have prices continuing to edge up slightly, maybe a few outlier sales, but it definitely was taking properties to sell, taking properties that much longer to sell and move. The Pasadena area, sales volume had dropped way off, and it was, again, properties were spending much more time on the market in terms to get them to sell. The Western San Gabriel Valley, now here, the price per unit had already dropped beginning in 2018, and days on market, again, we saw it climbing, and of course, sales volume had dropped off as well. And then the 710-91 corridor, in this area, I would argue, because the other areas had gotten so expensive and investors chasing yield, you still had price per unit being pushed up. The last 2 years, sales volume overall had stayed about the same. And again, this, as we'll see also in the Inland Empire, in my opinion, was a reflection of investors really chasing yield and moving out of the San Gabriel Valley into other areas that had, climbed well over 300,000 per unit. When you get into the Inland Empire, prices had been steady the last couple of years. Not as many deals trading, but prices had not dropped off. And yes, properties were on the market a little bit longer, but not that much longer than we had noticed over the last 2 years. And then the Inland Empire East, you have both sales volume jump and price per unit jump. Again, as investors, we're looking to chase yield. When I say chase yield, essentially net income, cash on cash, higher cap rates. Many of them moved east, and so that just, supply and demand drove those prices up. So again, these everything I've shared here is CoStar Analytics. Steve, if you want to give a reflection, or even if you have a counter viewpoint to what I see as the under thread here, what would you say these charts have told us of what was happening prior to March?
I think you've really identified the key point in pointing to values running up and affordability. Most of those charts that you just showed, in almost all of those areas, showed average unit pricing doubling or more than doubling over the past decade. It was really an impressive run for the LA multifamily market in terms of pricing and value growth, and that kind of grew out of how rents grew over that time. But in the last few years, 2018, 2019, while rents were still growing at a healthy clip, the pace of growth has slowed down quite a bit from what we'd seen earlier in the decade, in 2015, 16, 17. And as rent growth slowed and prices continued to rise at a pretty steady clip, the overall yield, as you mentioned, began to shrink for the average investor. So especially for, we didn't see quite the same drop off in investment on the west side of LA, where a lot of the high-end institutional product is located. Your national investors and deep-pocketed investors were still interested in LA product, but as cap rates compressed and yields compressed and the overall return on investment got smaller, you saw fewer and fewer areas there where the investment picture was compelling, especially for maybe more of the private investor that doesn't have that deep reserve of cash and capital to draw on. So while, by no means was the sky falling in LA, prices had just run up for so long. Pair that with the slowing pace of rent growth, and you did see, especially in kind of the eastern part of the county, overall slowing in investment volume and properties sitting on the market longer, as you identified.
So let's talk rents there, and of course we're talking about rents prior to this health concern that we're currently in. Is it a simple case of renters had began to use more and more of their discretionary income? A lot of things I read say up to 55% of their discretionary income. And when you pair that with stagnant wages, there's only so much that they could pay. I mean, is it as simple as that? Is that why we haven't seen rents continue to run the way they have?
I think so. So generally, when you look at slowing rent growth, the usual culprit is vacancies increasing, right? That is typically the thing that weighs on rent growth. But that wasn't the case in Los Angeles. Prior to the outbreak, overall apartment vacancies remained extremely low, around 4.5%, one of the lowest rates of any metro in the entire country. Despite that, we saw rent growth slowing. And so because the vacancy picture was so tight, the affordability that you mentioned is absolutely the main culprit and the main suspect in that slowing rent growth. You had years and years earlier, last cycle in the decade, where apartment rents grew by 4, 5, 6% year over year, and incomes just weren't growing that fast. Even though the economy was healthy, the housing costs and rental costs were outpacing the rate of income growth. That's just not sustainable over the long term. We had 3, 4, 5 years where rents really grew much faster than incomes. And I think what you saw in the last year or two prior to the coronavirus outbreak was growth, despite the tight vacancy picture, starting to return to a more sustainable level, more in line with income growth, because the average renter and the average renting household just can't dedicate more of their income to rent in Los Angeles. When you look at one important indicator, that the cost of rent versus average household income, Los Angeles is the most expensive metro in the entire country. Housing costs are higher in places like San Francisco and New York, but average incomes are much higher there too. So when you look at that spread between what people earn and what they pay to live or to rent, that spread's more pronounced in Los Angeles than anywhere else in the country.
To summarize again, even without the current health concern, sales volume had dropped off. Prices at best had hit their peak, but in many subcorridors had begun to decline, and it was taking properties longer to sell on the open market. So that's where we were, before this pandemic hits. So now we're post March, and I know you have a good amount of analytics you're going to be sharing with us, but I thought this would be interesting. So we actually took a poll of some of our loyal viewers in terms of two things here. One, what percentage of their rent was collected in the month of July? And second, essentially, what is their sentiment currently of the market? Are they pessimistic or optimistic? And what our poll found was that 83% of the respondents in July collected at least 90% of their rent or more. And only 5% of the respondents collected 80% or less. Now, is our poll reflective of what you're finding in the market at large, that even with tenants being encouraged not to pay rent, if you will, by politicians, they have essentially continued to pay?
Very much so. I actually, in the materials we'll be going through, I actually have a slide that deals specifically with percentage of rent payment. So yes, I think to this point, it's been an encouraging story that probably the in terms of how much rent is being collected, probably surprised to the positive, given the level of economic disruption. The very big elephant in the room, of course, is that those rent payments have been underpinned by the federal unemployment benefits and stimulus acts. $600 a week, obviously $2,400 a month. That will, even in a pricey place like Los Angeles and many places in the country, that will cover your rent for the month. Obviously, those benefits have expired, and we don't know what, if anything, are going to take their place. So while to this point the overall payment data has and payment percentages have been very encouraging, it also seems like we may be at an inflection point, and absent some kind of new federal stimulus, that the picture could start to change pretty dramatically this month.
Yeah, and I want to return to that point, and I'll return to the sentiment portion as we look ahead. So why don't we go ahead, Steve, then and dive into what you have to share with us here.
So what I'd like to start off looking at today is CoStar's daily asking rent series. We collect about 100,000 individual rental rates, confirm about 100,000 individual rental rates in Los Angeles County every single day. Most of those through apartments.com and our network of listing sites. We also have a research team that calls out to apartments and landlords in the market to try and get the sense of what's going on. So when you collect 100,000 individual rental rates every single day, it gives you a very nuanced, real-time view of what's going on in the market. And in this case, the impact of the pandemic is pretty clear. We could see that this is countywide and includes properties with at least 50 or more units. I know many of our viewers today are kind of focused on smaller properties. For this daily asking rent series, we're focused on these 50-plus unit properties because they tend to update with CoStar more frequently. So it just gives us a good frequency of the data. But we've seen similar trend lines in the below 50 unit space as well. You can see overall, LA County rents peaked at about $2.60 a square foot in the first quarter of this year. And then obviously the impact of the pandemic is pretty clear. Starting near the end of March, rents began to fall for the first time in almost a decade in Los Angeles. Fell about 5 to 6 cents a square foot to about $2.55 a square foot. You could see it leveled out in June and actually began to show some signs of maybe the market stabilizing a little bit and rents starting to creep up again. But with this sort of second wave or intensified first wave of cases, however you want to characterize it, as that's intensified in Los Angeles, you can see rents beginning to trend downward again. So obviously this is a very nuanced view of what's going on here. And that draws from all those rent observations we collect each day. And it does seem that in the early stages, at least, the rental rate has really kind of trended with the public health situation as things really got bad in the second quarter. Overall rents dropped as some public confidence started to creep back a little bit. Rental rates picked up again, and now as the public health situation has started to deteriorate again, so rents are showing some downward trends again. CoStar, we track the market by submarkets. We track 36 individual submarkets within LA County. And most of the areas that you touched on before, at least in Los Angeles, are contained in 3 of our submarkets, which you see on the map here. That's Pasadena area over here in kind of the northwest corner of the map. The San Gabriel Valley is, obviously these boundaries are somewhat arbitrary. We drew them ourselves, but this is the largest submarket in all of Los Angeles. There are about 62,000 market rate units in the San Gabriel Valley. And everything I talk about today, I should mention, is dealing with market rate units. So we are excluding subsidized housing, student housing, senior housing, really just trying to look at those units that are moving freely with the market at large. So about 60,000 units in the San Gabriel Valley here. You can see that stretches from Monterey Park all the way to the border with the Inland Empire. And then this last submarket here, and the map is a little bit messy because you have some waterways and canals that run through the submarket. But this is our Southeast LA submarket here, which starts just east of downtown in Boyle Heights in that area and kind of stretches down along the 5 corridor down into Pico Rivera, Whittier, La Mirada, areas like that. So we'll look at some data today that kind of breaks it down by these 3 different submarkets: Pasadena, San Gabriel Valley, Southeast LA. So just wanted to put that kind of in focus for a moment before we dug into the numbers.
No, it correlates very good with how we break down our corridors. So
perfect, great. So you can see, and this is actually a screenshot taken right from the CoStar product. This is looking at overall average rents per unit in the 3 main submarkets that we're looking at: Pasadena in green, San Gabriel Valley in blue, and the Southeast Los Angeles submarket in orange. And then you see the LA County average is that dotted black line, just for a reference point. So you can see Pasadena quite a bit more expensive than the other 2 submarkets. Average rents have crept north of $2,000 a unit. These are average monthly rents for all units, so pretty much the entire inventory from studios up to 3 and 4 bedrooms. Average rents in Pasadena had crept north of $2,000, and in Los Angeles as a whole, we were approaching that $2,000 a unit plateau. And you can see that's pretty significant growth. I've included here back during the last recession, when you can see overall LA rents were just above $1,600. We dropped down to maybe around $1,500 a unit during the last recession. But since that time, it's been nearly a decade of steady, outsized growth. And as I mentioned, in some quarters, growing by 4, 5, 6%. Really strong overall rent growth in Los Angeles. And while rents in San Gabriel Valley and in Southeast Los Angeles tend to be lower, that's largely due to the type of apartments there. In Pasadena, you have more modern and newly built projects and institutional grade products. In San Gabriel Valley, you have more Class B or what CoStar would refer to as 3-star product. That's maybe more workforce housing or geared toward families. And then Southeast Los Angeles, units tend to be smaller, older, generally lower quality. That's a pretty broad generalization, obviously, but this is all reflected in the rental rates here, and the average rents kind of reflect the composition of the apartment inventory in these areas. But you could see that while the average rents vary by area, the general trend lines are pretty similar, regardless of whether you're looking at Southeast LA or Pasadena or Los Angeles as a whole. We've had several years, close to a decade, of very healthy rent growth, with that largely coming to an end with the onset of the coronavirus pandemic. You can see we have already seen evidence of rent losses in both LA as a whole and in Pasadena, while in San Gabriel Valley and Southeast LA, rents to this point have not fallen. And I know we're going to get into the forward-looking portion a little bit later, so we'll hold off on discussing the forecast now. So let's dig into this phenomenon a little bit here. With some areas, rents are declining and some areas are not. This is looking at the overall change in rent from that March peak that we identified. When rents peaked in Los Angeles, how much have they changed since that time? This is looking at asking rents, overall asking rents. You can see that our losers here, the submarkets that have posted the strongest losses, are clustered either on the west side or around job hubs, employment hubs in Los Angeles. These, not coincidentally, are the areas that tend to receive the most new construction. So these are the areas that have your high-end, high-priced, modern, and highly amenitized product. So you can see most of our prominent major West Side submarkets: Venice Beach, Santa Monica, Greater Culver City, which includes Playa Vista, West Hollywood, downtown Los Angeles, which is obviously more new construction going on downtown than anywhere else in Southern California. So significant supply risk in downtown. You can see really pronounced losses there. And then the one that really stands out is Mid-Wilshire, which is sort of the Miracle Mile area, where rents have fallen by more than 10%. So there is a lot of newer stuff there. Mid-Wilshire is a little funny, though, because Park La Brea, the largest apartment complex in all of Los Angeles, is located in Mid-Wilshire. That's about 4,000 units just by themselves. And at Park La Brea, when they move their rents up and down, it moves the entire submarket. So that may indicate that Park La Brea just decided to drop their rent significantly, and it's being reflected in the entire Mid-Wilshire submarket here. But in general, as you look through these, it's our more expensive submarkets that are either close to the ocean or close to job centers in Los Angeles. Now, on the flip side of that, when you look at the submarkets that are performing well since the onset of the recession, places where rents have generally either held stable or actually increased, it's the opposite story. We're looking at suburban communities kind of on the periphery of LA County, areas that there is not a lot of new construction, not a lot of modern apartment product. So rents in these areas tend to be cheaper. We talked already about how affordability is such an important factor, right, in Los Angeles, and for many renting households, just they're not able to select where in LA they want to live. They're just looking for anywhere where they can afford to pay the rent and still be close to family and close to their jobs. So these are areas where, you know, your commute to the major job hubs and to most of the entertainment centers and attractions in LA is going to be unappealing. But rents are much lower in these areas. As a result, demand has held up better during the downturn. And to this point, landlords and property managers in these outlying areas haven't really felt the need to lower rents. Again, with the large asterisks that a lot of rent income in these areas has been kept flowing by the unemployment benefits that have expired. Now, Chris touched on earlier the overall rent payment and the survey that he had done among your members of how many renters are paying rents. And your generally rosy report and encouraging report about amount of rent being collected squares very nicely with what the National Multifamily Housing Council is reporting. This is based on data collected from about 11 million units, a little bit more nationwide. And it essentially compares portions of what percentage of renting households paid some portion of their rent in each month. And you can see when comparing 2020, this pandemic impacted quarter, to what happened in 2019, there's very, very little evidence of the drop off. In June, the numbers were virtually unchanged from June 2020 to June 2019. So I think this has been a surprise to most people in the industry, given the level of economic disruption, tens of millions of people out of work. I think we had expected to see rent payments drop off, but that's not been the case so far. There's two very important caveats to this data, though. The first is that it only tracks households that have made some percentage of rent payment. It doesn't say what portion of rent they paid. So this doesn't indicate that everyone's paying all of their rent. And to my mind, the biggest elephant in the room and the most important asterisks is that this is really being underpinned again by the unemployment benefits stemming from the CARES Act that was passed in the early months of the outbreak. $2,400 a month goes a long way in Los Angeles. It goes even farther in most other metros in the United States. That's been enough to help people make their rent payments. Now that Congress has been unable to, and the president have been unable to come to any agreement, and these benefits have expired, it's really anybody's guess on what comes next. If we have a new round of benefits coming, if we do have a new round of benefits coming, what shape they'll take. So this graph, once you add at the end of August, when you add the August data in, may look markedly different than it's looked in the early months of the outbreak. So that's kind of the overall framework. But when we look at the health of a market, we generally look at the supply interplay between supply and demand and how that influences the vacancy rate. So this is a little bit of a scary looking chart, but it's not actually as bad as it looks. Essentially what we're tracking here are three things. Your quarterly change in demand. So that's just how many more units in a given quarter were leased or vacated relative to the prior quarter. And that's what you're seeing in these yellow bars here. Now, the other side of that coin is quarterly change in supply, how many new units were built. And you can see during the last downturn, you actually have quarters with negative supply. That indicates that more units were demolished than were built in a given quarter. You can also see recently we've had negative demand. So that means we have many more vacant units this quarter than we did in the prior quarter. So anytime the supply, the yellow bars anytime demand, the yellow bars outweighs supply, the blue bars, your vacancy rate is going to trend downward. And that trending downward is what we enjoyed for most of the last decade. You can see that after the last recession, when vacancies peaked at about 5%, they compressed for most of the rest of the decade until they got down to about 4% and really held there for years, held right around 4%. In general, those yellow bars, the demand was sufficient to keep up with the limited amount of new building that we can do in LA. Chris, earlier you highlighted that even before the coronavirus outbreak, that we had been starting to see some changes and shifts in the market. And you can see that even before those sharp negative absorption bars, that vacancies were trending upward. Some of that was due to new supply. We were having more new apartments come online. Almost all of them high-end, Class A, 4 and 5 star, pricey apartments. So demand for those apartments hadn't quite kept up like it had earlier in the cycle. And then overall, the levels of apartment demand were slowing just a bit relative to maybe what you saw earlier in the cycle. Indeed, at the end of 2019, before anybody had heard of the coronavirus, we had negative absorption for the first time in almost a decade in Los Angeles. And I think that ties back to the affordability concerns that we've talked about. Prices had just run up so high that there were some portion of renter households that just can't afford that rent anymore. They're leaving LA for places like the Inland Empire, Vegas, Phoenix. And obviously, as people leave Los Angeles and the population stagnates or declines, overall demand for housing is going to soften too. So that's kind of the situation prior to the outbreak. It's pretty clear what's happened since the onset of the pandemic. The sharpest negative absorption we have ever recorded in Los Angeles, and vacancies now at an all-time high, the highest rate we've ever recorded, north of 6%. The reason that Los Angeles is such a popular target for investors, for those who can get permitted to build here, because as you can see, even in the worst economic and public health crisis of our lifetimes, the sky is by no means falling here.
So Steve, if I could just jump in for a second, because I can visualize some of my close clients looking at these bar graphs saying, Chris, just tell me what I need to know. So clear up anything that I describe improperly here. But essentially, if I'm a mom and pop investor, 1960s constructed building, number one, my asset class is not competing against these other asset classes that have had to offer these exorbitant concessions of 1 and 2 months of free rent. And so it's not likely that I'm going to have to do so in order to get my places rented. And to that fact, when we looked at the change in the asking rents, some areas, even during this pandemic, have actually gone up, surprisingly, or at least stayed the same of what they were prior to the pandemic. So in general, my rents are secure in place. And to that point, for those of you that are familiar with the city of Covina, we own a building there that we're renovating and renting. And for a 500 square foot, 1 bedroom, 1 bath, we just rented that for $1,695. I mean, that's a high rent for a small unit in the middle of this health crisis. And so rents are strong. Vacancy, while it has crept up, it looks like, again, it's impacting those areas that have a lot of new supply, or a lot of these higher end communities where the tenants have a choice given their type of employment. And I think another side takeaway of this is the winners and losers, so to speak, in terms of rent collection. a lot of it has to go to luck of the draw. Your tenants, were they essential workers? And if essential workers, they continued to work through this pandemic. And if not, and laid off, and they were unemployed because of the government stimulus, they've had $2,400 extra a month. Many people claiming to be making more money on unemployment than when they were employed. And so that has propped up the market as well.
Absolutely. And to your point about the mom and pop owner, the 1960s Class B, Class C construction, I think while we're talking about submarkets in this chart, you can take these submarkets on the right side as kind of a proxy for that type of asset, that type of property. In places like North Hills, in the San Gabriel Valley, Tarzana, virtually everything is an older Class B or Class C property. So this performance here, where you see these outlying submarkets outperforming, that is due to the strength of that asset class, the Class B, Class C sort of workforce housing, for a lot of the reasons that we've talked about, primarily affordability, demand for that kind of reasonably median price product is so strong and so consistent in LA that we haven't seen much weakness in that asset type so far. Okay, so moving on to sort of the capital markets and the investment picture. You noted early on, Chris, that you've seen a slowdown in some of the markets that you are primarily covering in 2018 and 2019. From an LA perspective, a wider perspective, we hadn't really seen that slowdown yet. We had about close to $11 billion in total investment in both 2018 and 2019. That led the entire country. So what that may indicate is that you were seeing investments start to shift from the eastern part of LA County, where, as we talked about, yields had really compressed and prices had run up. And now maybe you have bigger, deeper pocketed investors that are driving sales volume in the past few years, chasing that more institutional product in central LA on the west side. But regardless of that, you can see that the outbreak has really changed the investment picture dramatically, where every quarter after quarter for close to a decade, we had over $1 billion in apartment sales. Concluded that run has come to an end. In the second quarter of 2020, only about 800 million in sales. So investment activity didn't dry up entirely. We still had some deals getting done, but relative to what was going on prior to the outbreak, obviously a dramatic slowdown. And this is just what's taken place so far this quarter in the third quarter. So you do have some opportunistic investors, maybe who've had some money in the safe or in the bank account waiting for a downturn, kind of pouncing on opportunities here. But for the most part, it seems like people are kind of content to sit on the sidelines and let the economic waters settle a bit before jumping back in.
Now, we want to take the information that we've discussed thus far and chunk it down even more granular. So going back to our corridors, the 605 corridor, which again consists of Montebello, Whittier, Pico Rivera, Norwalk, just think up and down the 605 freeway, south of the 60 freeway. What my team and I have done is looked at sales since the end of April. Now, going back a few videos, you remember back in the middle of the stay-at-home order, we recorded a market highlight video where I mentioned it was too early to tell what did this pandemic mean to values, and that we would need to track those buildings that had been listed during the pandemic, see where they eventually sold, how many went unsold, and that's the data that we're looking at now. So since the end of April, you've had in that 605 corridor, you've had 9 multifamily properties sell and close escrow. You've had you have 2 that are currently pending, and you have 6 that are currently for sale. Well, what's our cap rate? The cap rate now, at least of those that sold, is 4.6%. That is an uptick from where we were from the end of last year. In general, the average price per unit is about $232,000. Now, keep in mind, especially if you've been watching our 5-minute multifamily, there's individual markers to value a property. Price per unit is just one, so it might not be a clear indication of the value of your property, but it is one of the markers. Eastern San Gabriel Valley, again, think between the 10 and the 210 freeway, east of the 605. You've had 6 multifamily buildings sell since the end of April. 1's currently pending. 7 are for sale. And the cap rate of those that sold is 4.7. That's significantly higher, about half a percentage point higher than we were at the end of last year. East Los Angeles, East LA, El Sereno, the surrounding area there, think 710 Freeway and West. You've had 6 multifamily buildings sell. 2 are currently pending. 10 are for sale. Now, I would have to venture to guess, because I own multifamily in this area as well, the reason for the significant number of buildings for sale there, because that's a lot for that area. Normally, you don't see that many, is aside of the statewide rent control that we currently have for all cities, non-incorporated Los Angeles County has its own version of rent control, which is very similar to LA City. And one of the components of that is a limit of 3% annual increase in rents. And in their law, it's even written that some years you may have a 0% increase depending on what inflation does. So I imagine investors are looking to, at least some of these investors are looking to exit that area. And if we're going to live with rent control, at least get into an area where they give you the 5% plus inflation, which many cities have under statewide rent control. Now for Pasadena. Now Pasadena, again, we lump in Pasadena, South Pasadena, Altadena as a submarket. 7 buildings have sold, no buildings are pending, and 12 are currently for sale. You have seen over the last 60 days a number of buildings come up for sale in the Pasadena area. The average cap rate there, 4.5%. The Western San Gabriel Valley, this is Alhambra, San Gabriel, Temple City, in this general area. Basically the San Gabriel Valley until you hit the 710 freeway. Again, between the 10 and 210 freeway. We've had 4 multifamily buildings sell. No buildings are currently pending for sale. And 10 are actually, so we have 0 buildings pending, meaning there are no buildings in escrow. And 10 buildings are currently for sale. Again, for this area, that's a pretty large number of properties. And the average cap rate, 3.8%. That's still a very strong cap rate from a seller's perspective. So that tells us values are still strong in that area. The 710-91 corridor. So here you'll be thinking Huntington Park, Southgate, Cudahy, Maywood, again, all the way down to the 91 freeway. You have 9 buildings that have sold. 3 are currently pending. 6 are for sale. Not a whole lot of inventory for sale, but the cap rate, the average cap rate is now touching and heading towards 5%. That is relative to the last 5 years, that's a nice yield. And I mentioned in my comments earlier, buildings are trading there because people are chasing yield, hence 5% cap rate. The Western Inland Empire. So we're talking Pomona, Ontario, Montclair, Fontana. We've had 1 building sell, 1 is currently pending, and 4 are for sale. So, and the cap rate of those that have sold are 5.4%. So again, if you're looking to chase yield, you can head to the West Inland Empire. I own myself in that area, very strong rental market. It's not what many of you might think of a low C-class area. It's not that. Of course, it's block by block, but in general, much better rental area than many may assume if you've not ever invested in the Inland Empire. But not a lot for sale. So landlords, in general, we can say landlords must be happy in the area. And then the East Inland Empire, 1 multifamily building has sold, 1 is currently pending, 3 are currently for sale, and the cap rate there is about 5.5%. So we, as reflected in the graphs, not a lot of turnover since April. A lot of investors saying, in these times, if you don't have to do something, why would you? Now, did you want to share any of your other slides, or you think we're in good shape?
If we wanted to do just a quick look at where we think the market might be headed, because this is kind of what informs our rent growth forecast, okay, and our pricing forecast. And of course, we talk about a grain of salt. Even in normal economic times, forecasting is an attempt to predict the future. It's inherently uncertain. But CoStar had gotten pretty good at it because we have such a long history of commercial real estate data. We've seen how the market performs through multiple cycles in the past. And so we've gotten pretty good at developing reliable forecasts. But now there's so much in the air that we didn't have to think about before. Primarily the public health situation, right? That's never a factor that has gone into a commercial real estate forecast before. But here's what we're looking at based on our best assumptions. You've seen, and we talked about the earlier part of this graph where we've already seen the sharp demand drop off. Now, the economic assumption that economic forecast that kind of underlies this commercial real estate forecast predicts that the worst of the job losses are behind us, and we have seen some evidence of that, that companies began to add jobs again in the second quarter, and the job growth began to creep back a little bit. But you could see that the overall forecast here is that demand will remain pretty stagnant, that we're not going to have these major losses that we saw in the earlier parts of the pandemic, that the apartment demand will remain pretty stagnant really through the first half of 2021. At the same time, you're going to have a lot of new apartments still delivering. There's a lot still underway. There's no evidence really that developers are looking to delay opening. They've still got to pay taxes, still got to pay their mortgage. So they're opening their doors and trying to get tenants in there. So when you have a lot of new stuff delivering in an atmosphere of stagnant demand, that will continue to push vacancies higher. Our forecast is at the kind of the worst part, or at the epicenter of this for vacancies to get up to about 7%. So obviously, that's very high from a historical perspective, much higher than we've ever tracked, and a complete departure from this generally 4% vacancies we've enjoyed for most of the last decade. But again, before the outbreak, the national vacancy rate was about 6.5%. Really speaks to the strength of the LA market, that in the worst financial and public health crisis of our lifetimes, our forecast is really just for vacancies to get it back up to about where the national level was prior to the outbreak. So, I don't want to belabor the point about strong demand and limited supply here, but all those factors really combine to underpin the strength of the LA market and should aid a recovery whenever the public health situation doesn't. And with a quick look at pricing here, this gives us kind of a relative view of the three submarkets that we focused on today. Again, Pasadena in green, LA County, this dotted black line, San Gabriel Valley in blue, and Southeast Los Angeles in orange. So we could see pricing in Pasadena had gotten up well above the LA County average, up around $375 a unit. But in that more Class B, Class C area, the type of product that's more prevalent in the San Gabriel Valley and Southeast LA, prices really still up dramatically, just even in the past 5 years, pushing $250,000 a unit in Southeast LA and $300,000 a unit in the San Gabriel Valley. So these are price points that, Chris, I'm sure when you started doing these presentations 10 years ago, would have been pretty unimaginable in these areas, $300,000, average of $300,000 a unit. But the overall strength of the LA market, those years and years of strong rent growth that we saw, it pushed up prices everywhere. You had a lot of investors during the last expansion that were priced out of West Side markets or Central LA, but really found a lot of value in San Gabriel Valley and Southeast LA, doing value-add investments or just more reasonably priced investments in those areas. So you can see the overall forecast for pricing, and this should be kind of taken with a grain of salt because we saw how little trading is going on right now. So there are very few deals to base a forecast off of. But if our overall rent growth projections hold true and rents continue to decline through the end of this year, that will obviously limit returns and detract from returns in these buildings and translate into an overall drop in pricing. And you can see while the levels vary from submarket, that the general trend lines are about the same. We're looking at a forecast for about a 10 to 15% drop in per unit prices, average prices, before the market regains its footing and really gets back to normal relatively quickly. This is sort of predicated on an assumption that the economy gets back on its feet in mid-2021 and continues to accelerate through mid-2022. But if that proves to be true, then from a pricing standpoint, we should have made up most of these losses that we're forecasting within a year or two. And I think that kind of speaks to the underlying dynamics in LA that we've talked about today, the strong demand, the relatively limited competition from new supply. All of those make this a very compelling market for long-term investment. It's a tough place to make a quick buck because prices are so high, but with our diversified economy, our huge population, we're insulated more from some of these shocks that a smaller or less diversified metro might have during a downturn. And I think we'll see evidence of that in the coming year or so, that LA will probably weather the storm better than more heavily built areas or less diversified areas.
I'd like to share some data with you. Essentially, we looked at the last recession, and we looked at values from 2006, the peak, to about 2011, which in our submarkets was about the bottom of the market. What you're looking at here essentially is we took the highest price point that we could find, or we eliminated some outliers, new construction and so forth. But again, keeping in mind the general supply that turns year after year in these sub markets. And this is the percentage in values that we saw, again, from 2006 to 2011. You had the 605 corridor went down as much as 21%. The East San Gabriel Valley, which can be a discussion for another time, but who was really the beneficiary of a lot of foreign money that came into the States at that time. So it was propped up very well from those investors. East Los Angeles, again, it's one of those areas. It's great when it's great, but it's horrible when it's horrible. And so it dropped off significantly in terms of price per unit. Pasadena, again, they had dropped significantly in that area. Western San Gabriel Valley by 14%, and then the 710-91 corridor by 33%, and then the Inland Empire between 20 to 30%, depending on what section of the Inland Empire you're looking at. And the reason why I bring this up is because we showed this. I mentioned again our educational event that we had in March, and we wanted, because people were very nervous at that point. Again, we're in front of a crowd. March 19th, and we were sharing with people, well, if the past is any indication of the future, it shouldn't be any worse than this. And so what you shared with us is that we're not going to see declines anywhere near what we saw during the last recession. And again, at worst, for most of these submarkets, it might be 15%. But keeping in mind that we turned off the world economy for nearly 3 months, if we had a 10 to 15% slip, that would not be the worst of things. And again, CoStar is predicting that we would bounce back very quickly, similar to what we've seen the stock market do. We're talking about almost new highs today at the recording of this video on the stock market. So just as strange as this pandemic was, in the return, the economies, the return of commercial property values should bounce back faster than you would normally assume from if in fact this is a recession.
Yeah, I think so. I would just highlight that the pricing information we looked at earlier was medium pricing, whereas this peak to trough is naturally going to be a little bit more volatile. So we think median pricing is going to fall by about 10 to 15%. And that would not, that's obviously not the same as a 40% peak to trough drop in a place like Pasadena. So just so we're clear, we're maybe not comparing apples to oranges there. But I think your larger point is correct. There are some indications that, in terms of vacancies or overall rent losses, that this recession is going to impact the local market more than the last one did. But the other kind of outlying economic factors, particularly that this has fallen more heavily on individuals and lower class than it is corporations and things like that, probably mean that the overall amount of investment and overall pricing is not going to pull back in LA long term like we saw to the extent of the housing crisis. We'll see. Obviously time will tell, and if things stay volatile for years and years or an extended period of time that could change. But kind of as I said, the underlying dynamics for LA, it's hard to do, but when you strip out what's going on with the pandemic, that sort of structural foundation of the market that was so attractive prior to the outbreak is still there and is really not going away.
So the good news is multifamily still proves to be, even when you look against the other sectors, how retail is doing right now, office space, I mean, they're taking a beating, which is a reflection of the changes that this pandemic has brought. But multifamily is strong, will continue to be strong. And I think that's reflected in, I mentioned earlier, part of this poll, the second question was, what is the sentiment amongst investors? And the far majority tend to be more optimistic than they are, or they outnumber those that are pessimistic. And so there's reason for such, right? I mean, again, if you correlated the values directly to vacancy and asking rents, and so as this turns around and as rents get stronger again, so will the values right alongside of it. I think that's important for our viewers, so that again, many people would argue, well, because of the eviction moratorium, because of rent control, because of these various things, values should fall more. But again, that's not an argument. If the fact is, if they're not, then they're not, right? I mean, we can argue that maybe that we should see, just like people could argue that the stock market shouldn't have bounced back as quickly as it has. But the fact is, it's back, right? And we're talking about almost new highs. And so there is plenty of reason as a landlord to be optimistic going forward. Any other closing thoughts that you would share with our viewers? Again, if I'm a mom and pop investor, I'm thinking about my long-term investment goals. I'm even thinking about the building of my financial legacy, my heirs that will come behind me. You've been with CoStar 15 years, just a general sentiment of how you've seen multifamily perform, good or bad market?
Yeah, I mean, there's a reason that multifamily has been kind of the preferred investment vehicle, both in Los Angeles and the nation as a whole over the past few years, because of the resiliency of that space. People can stop going into the office, right? They can stop going to the store, but they're still going to need a place to live, right? Regardless of the overriding economic conditions. And in a place like Los Angeles, where for decades we have not been building enough to keep up with the demand for housing here, a year or two of disruption, while it will certainly cause some short-term pain, and I don't want to downplay the implications for individual owners and individual projects, but from more of a macro perspective and a long-term perspective, there's still plenty to like about Los Angeles, and more than anything else, that disparity, that long-term disparity between supply and demand, the inability to build enough new housing to keep up with the demand for housing in this area, really sort of insulates those owners that are lucky enough to own in LA. It insulates you from the highs and lows of other investments. And really, when you look for the long term, it's hard to see anything really dramatically changing the dynamic that has made LA multifamily such a compelling investment in the past. It will remain so in the future, regardless of these short-term spikes and shocks to the economy.
Well, Steve, thank you. I appreciate your time. I know our viewers appreciate your input here. They're just looking for a beacon of light, right? There's a lot of darkness right now. And so that's why we wanted to give them an update exactly where is the market as of today. So thank you, sir. Thank you for being so generous. Thank you to you and CoStar.
Happy to be here. I hope it was educational for your listeners, and thanks for inviting me to join.
I hope you found today's interview informative. My goal, the reason behind these videos, is to ensure you as the landlord have the information, the resources to help you in the day-to-day management of your multifamily properties and in the building of your financial legacy in multifamily real estate. Be sure to share a comment with us. What did you like? How can we improve? Who else do I need to go out into the market and interview that would assist you as a landlord? Please give our video a like and be sure to share it with other landlords that you know. Keep in mind, CoStar's data is not readily available to the open market. It's a subscription-based service that typically only brokerage houses have access to because it's very expensive to pay for this service. But CoStar was nice enough again today to be open to this interview, to open up their analytics to share with you, our viewers. Be sure to share the video. And keep in mind, coming up here over the next couple of months, we are going to host our educational, what used to be a luncheon will now become an educational webinar, given the current issues in society. We can't have large gatherings. And over the last 10 years, several thousand landlords just like you have come through our events, and we've had a whole host of individuals on our speaker panel that speak to the legality of owning multifamily, protecting your assets, growing your wealth, protecting your rental income from Uncle Sam, and everything in between. So it's a what you saw here today. Think about over the course of a few hours, the legal aspect of owning multifamily real estate, the economic portion of owning multifamily real estate in terms of taxation, asset protection, market forecasting, and really, again, how do you build your financial legacy on a strong foundation that can't be rattled when things like a pandemic or when we go through some other change in the market, but with the sound advice, you have a strong foundation for your legacy. Chris German from The Apartment Dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.